Good morning and welcome to today's Week Ahead briefing. My name is Ogutu. I am the head of research at Zenith Capital. I will walk you through the Kenya macroeconomic updates and also the equities and fixed income segment. The resources have been shared on the handout slide, and in case of any questions, you can use the chat function from your end. Let me kick it off with the macroeconomic developments. Last week, the CBK Monetary Policy Committee met. In line with the expectations, they retained the benchmark central bank rate, or rather the CBR, at 7%. One of the things that came out from the Monetary Policy Committee statement was that the private sector credit growth for the month of June was at 7.6%. This was slightly lower than the 8.1% that was recorded in the month of May. But having said that, we're still in the current COVID-19 environment that there is no robust extension of private sector credit. And in our estimates, we're seeing that in the month of June, that the actual increase in private sector credit growth was around 16.5 billion shillings, which is not something that could move needle. Having said that, and another thing that came out was that the restructured loans in the banking sector was to the tune of 144.4 billion shillings. That is representative of around 29% of the total banking sector loan book. So it's quite phenomenal, the amount that has been restructured. Moving on, another issue that we put out in the MPC Outlook note that we published last week was that the disinflationary trend in the economy. Why inflationary? Disinflationary is what is a decline in the inflation on a month-to-month basis. And for the month of June, inflation was around 4.6%. And the July inflation was published on Thursday, and it was around 4.36%. That's the overall headline, overall inflation. Stripping off the fuel and food inflation, we are seeing that core inflation was around 1.6%. Basically, core inflation is telling us the demand economic pressures in the economy, and it's been subdued. We all know about COVID-19 and its impact on the economy. Incomes have been reduced or slashed. People have lost their jobs, so it has an impact even in the core inflation. Hence, it's still subdued 1.6%. We're expecting the July purchasing managers index. That's the composite trading. In other economies, they do both the manufacturing and the service PMI, but clearly we just do the composite trading. The previous trading was 6.6. That's for the month of June, and that one was also a time from 36.7 that was recorded in May and 34.8 that was recorded in April. So this going to show whether there is a recovery or we are still subdued levels. Another thing to mention that print below 50 is showing that there is contraction in the economy. A print above 50 is showing that there is expansion in the economy. So that's something that we are keenly looking out to, particularly the pulse of the direct sector. Moving on to the equity segment, I'll start with reviewing what happened last week. Both of the indices that we tracked, that's the Nairobi All-Share Index and the NSE 20 declined. NAFI by 1% to 133 points, and NSE 20 by 4.4% to 1,804 points over the course of last week. Third declined by 54%, equities and over that is to record 1.53 billion in the course of last week. What was interesting was the participation by foreigners. It was around 59.8%. This service the local around 40.2%, and they record net inflows to the tune of 49.4 million. I can't remember the last time that we saw inflows from foreigners, so this was quite striking in our view. And they were having a bullish trend on Jubilee, Equity Group, and EABL. Those are the counters that foreigners had the inflows onto. We are seeing that this the foreigners are seeing attractive entry points. Hence now they are starting to come in, and because that they are dominating the local activity, we are seeing that if this inflow continue is sustained, with it even reversing the negative trend that we've seen in the indicators that we track. So that's quite something that we are looking forward to in the course of the next coming weeks. EABL, East Africa Breweries Limited, released their full year 2020 earnings over the course last week. We saw that net revenues declined by 9% to 74.9 billion shillings, and profit after tax declined by 39% on a year-on-year basis to 7 billion. Basically, these numbers were dragged by the second half period. Second half period for EABL's financials is between the January to June period, and in that period, actually the fourth period between April and June, that's where we saw the aggressive containment measures, whereby bars were closed, social distancing were put in place, and it had an impact on the numbers. Let me just give you how it performed. We are seeing that the volumes declined by 28% in the second half period, and profit after tax. The first half period profit after tax was 9%, but come the second half period, it declined by 104%. We got the 39% from. So it's just telling us how second half was an ugly period for EABL. But that said, they still retain at current prices of around 154.75. The target price is 201.68. That said, we're still seeing that the company did not announce the final dividend for the period against 6 shillings dividend that was announced for the full year 2019 financials. So that is something, even as investors are looking to get into this stock, they need to be aware that dividend payment perhaps may not have be forthcoming in the next financials. Moving on to a report that we put out last week on the banking sector, 2020 banking sector review, and it's coming against the backdrop of half-year earnings, which are expected to trickle in for this month. Expectations for full year 2020 earnings, there are key 4 themes that we looked at into the report. The first one is we expect negative growth in full year 2020. We expect an average decline to the tune of 11.9%. That is across the sector. Of course, there could be variations between the banks, but across the sector, we're expecting a decline of 11.9%. The other theme that we're looking at is dividends cut. The banking sector, one of the historically appeal to the banking sector is the dividends that has been coming from the stocks, either be it interim dividends or final dividends. And in our view, we expect that there'll be no interim dividends from KCB, Absa, and StanChart, basically due to the COVID-19 uncertainty, and primarily will try to cushion their capital. And we see that this lack of payment of interim dividend is not due to a worsening of fundamentals, and that's quite key. But basically, banks are trying to position themselves and having some capital buffers to ride the storm. We expect that in the event that there is an improvement with all this in the current environment, we expect a final dividend is 3 banks, that is KCB, Absa, and StanChart. We don't expect the final dividend from Equity Group. Remember, around May, Equity Group out and withdrew the full year 2019 dividend recommendations. So based on that, we still expect that the trend will continue in the course of this full year 2020 numbers, that there will be no dividend payout from Equity Group. The other thing that we are seeing is loan book restructuring. Earlier mentioned 29% of the total banking sector loan book has been restructured. That is to the tune of 844.4 billion. we expect it to be quite worse as the pandemic progresses. This, of course, will have an impact on subdued growth in net interest income, because basically as banks restructure the loans, so we don't expect that they'll get interest income from those loans that have been restructured. So that has an impact of subdued growth in net interest income, and subsequently, net interest margin is expected to decline by 1.4% across the sector. And finally, we expect elevated inflation, though this is not as profound as what initially had been stated, but we still expect nonetheless that banks will continue paying for toxic loans. Our current buys in the banking sector, KCB has an upside of 44.3%, Equity has an upside of 34.3%, Absa Group has an upside of 24.2%, and Cooperative Bank has an upside of 24.6%. We have a whole recommendation on stats, but basically stemming from the fact that its upside is 1.7%. Now, let me just close it with the fixed income. Sorry, I have jumped the gun a bit. Yes, to the fixed income review and outlook. As earlier mentioned, so there is a dip in equity segment to the tune of 4% to 1.5 billion last week. And on the other hand, on the fixed income side, we saw activity jumping to 7.6%. And that took us to 21.7 billion in terms of the secondary market within the fixed income side. We've not seen these records in 2020, but that is tying to the cracks of even our cross-asset strategy report, is that investors to be looking at equities and also income, but not just be fixated in one asset class. So if there's no opportunities in equities, they can also jump into fixed income and vice versa. And that's what is also playing out over the course of last week. Is it because liquidity are normalizing? Well. What is so last week? T-bills had a performance. The subscription rate of T-bills was 118.7%. Previously, the average for the previous weeks in July was 274.2%. So this was a big decline, though it was still above 100%, but it was still a deep decline. And yields also going up by 1 basis point on average. So that's something that we could see. Perhaps it's just telling us that yield liquidity is normalizing. We saw also in the course of last week on Wednesday, the CBK did have to mop up the excess liquidity in the market. So that's also another indicator that perhaps liquidity was normalizing. And that is supported by the fact that the repo rate, that is on the 7-day tenor, went up by 0.23% to 4.9% over the course of last week. But then another thing that played out last week, which we think also sort of the liquidity in the market, was CBK came and announced the August issues. The August issues are totaling 110 billion shillings, which is quite phenomenal, of which 70 billion is on the new 11-year infrastructure bond. And then there's a tap sale. There's a tap sale. Basically, this paper was issued in 2018. It is a 20-year paper, so they are reopening it again. But now investors now to place their bids, their amounts that they want, rather than even putting their yields. So that's the difference with the tap sale. So we think that perhaps investors have started looking at this August issue, which took out the liquidity from the system. We think that also played out over the course of last week. In particular, like this tap sale trade, the was issued in 2018, and this is a paper. So formally, it's called SXD 2/2018/20. We say that it has an attractive entry price. If perhaps you're joining in this all and you have no idea how fixed income works, there's an inverse relation between the yields and the prices. So the yield that has been put in the tap sale is 12.93%, but the current implied is 12.64%. So basically, you're getting it at a cheaper price than if you go to the secondary market right now. So that's what's the attractive price. And finally, and most importantly, it has a higher coupon rate of 10.2%. Let me leave it there. Thank you, and hand it over to Mark, who will take you through the global market segment.
Thank you, Churchill. Just bear with me 1 second while I share my screen. Just bear with me. Okay, good morning. Thank you for joining our week ahead briefing. I'm going to be covering the global financial markets, so let's get right into it. I'm going to run through the economic calendar top to bottom. Then we're going to dive into a few key components in slightly more detail. So already we've had Japanese GDP and Chinese manufacturing data earlier this morning. Then we have German, UK, and US manufacturing data all scheduled for release later today. Tuesday is a big day for the Australian dollar. We get retail sales data, and then an interest rate decision from the RBA, so the Royal Bank of Australia. It's widely expected that they leave interest rates unchanged at 0.25%. However, the concluding statement will be heavily scrutinized by traders. So any key phrases, any changes to the tone of rhetoric, can we gain any clues on future guidance or future monetary policies? On Wednesday, we have employment data out of New Zealand, so keep an eye on that Kiwi dollar, NZD. Then we have PMI data out of the UK, and later in the day out of America. So PMI stands for Purchasing Managers Index. It measures the activity of purchasing managers. Generally speaking, a reading above 50 indicates expansion, and a reading below 50 signals contraction. Then we have ADP non-farm employment change. ADP performs payroll services for approximately 400,000 US businesses. So it's going to give us an early insight into that government-released non-farm payroll number scheduled for Friday. More on that to follow in due course. Then we have crude oil inventory, so a great indication of the recent supply and demand dynamic for WTI. Then Thursday is a big day for GBP, the Great British Pound. We get an interest rate decision from the Bank of England. Similar to the RBA, it's widely expected that they leave interest rates unchanged. However, ensure to review the meeting minutes. Try and gain an understanding of the current stance of these key central banks. We then have initial jobless claims data out of America, which is a weekly staple on that economic calendar. Then Friday's the big one. So employment data for both Canada and the US, and most notably those non-farm payroll numbers. It's typically the godfather of all economic data points. So what exactly is the non-farm payroll, or NFP, as it's more commonly known, and why is it so important to us as traders? The data represents the total monthly increase or decrease in paid US workers of any business. However, the data does not include government employees, non-profit organizations, private household employees, or any workers within the farming and agricultural sector. The non-farm payroll figure accounts for approximately 80% of US businesses that contribute towards that domestic GDP. So a monumental reading that really helps to gauge the health of the American labor market. Generally speaking, the number is released on the first Friday of every month, and it's going to capture employment trends for the month previous. So Friday's figure is a reflection of July's payrolls. And due to that early release in the calendar month, it gives us an early insight into the tone of upcoming CPI, PPI, and GDP figures, all scheduled for the release throughout the month of August. A stronger than expected reading is going to be bullish for both that US dollar and domestic US indices such as US 30, UT 100, US 500. More payrolls, so more people in jobs, higher income across the board, higher consumer spending, more corporate revenue, etc., etc. It's important to know the forecast figure. Have that number ingrained in your mind. So a month-on-month increase of 1.65 million payrolls. That is what's being priced into the markets. That is what the release will be compared against. Not last month, a 4.8 million increase, the data will be compared against this month's forecast. More so than ever, data release of late has provided great opportunity for traders. Results have been very erratic, and we're seeing data at both extremes of the spectrum, and that in turn is providing an abundance of great opportunities for traders. Saying that, we know NFP is such a huge event on that economic calendar, lots of eyes on it, it's bound to be in the media in the coming days, but that doesn't mean we absolutely have to trade it. I don't react instantly, nor would I recommend others, so be disciplined, wait, and analyze those numbers as they're released. And due to the evolving nature of the marketplace, we cannot compete against the speed of these trading algorithms. The algos are working in micro, milliseconds, impossible for the human eye to beat those algorithms to the trade. We're going to see an instantaneous spike after the figure is released, and that is likely to be algo driven. From my experience, these algos are quick to take profit, which in turn results in a pullback from any initial spike. So, for the sake of this example, if we see a decrease of 2 million payrolls month on month versus the expected 1.65 on Friday, so a far weaker reading than the forecast suggested. So in this instance, I would anticipate the US dollar to depreciate. So I'm looking to buy euro dollar, the euro to appreciate in value versus that US dollar. We might see an immediate spike higher in euro dollar, algos buying the market. Quick profit is taken, so selling out of their long positions, pulling the market lower before an uptrend plays out. And it's that pullback that I'd be looking to execute my euro dollar long trade. It's just something to be mindful of. It's something I've noticed having watched the markets react to economic data such as the NFP for several years now throughout my career. Let's go back to Tuesday's economic calendar, so a key day for the Australian dollar, and that leads me into my trade of the week. The trade of the week is to buy GBP AUD, so the Great British Pound versus the Australian dollar. I'm just going to pull a chart across now so you can see. So I'm looking for GBP AUD. A key component in my trade identification process is what I call top-down analysis. You're simply analyzing a higher chart time frame and gradually moving down into a smaller time frame, and you're building a picture of the market throughout this process. So if we start on a weekly, let's have a look at a weekly chart. Just to simplify that, I'm telling myself, okay, we're in an uptrend. Very simple. Just quickly draw the lines in. Early 2016, gradual uptrend. We have seen a pullback of late, this sell-off here, but we are seeing higher lows. So I believe that that uptrend is still intact. As you can see here, although we did get a sell-off, we did manage to stay above that previous low here. So I believe we're still in an uptrend. So moving on to a daily chart now, moving down the time frame. As you can see, price has really respected this downward channel. I'll just quickly draw that in there for you to see. This is going to be very vague. But you can see that price has really respected this channel here. But we've now broken out of this channel. So a real bullish sign. Market bears were unable to defend that line of resistance. So it appears that the market is really building a solid technical foundation for a bullish trend. I've built my bias by analyzing these charts throughout the time frames. I then look to a 4-hour or 1-hour chart time frame, and I'm looking to identify precise areas to enter a long position. And I'll be doing that over the coming days. Of course, we're going to see volatility on Tuesday, and that just might be the pivotal moment for me to enter a long position. In regards to company earnings, most notably, we have Disney on Tuesday and Uber on Thursday. We saw incredibly strong earnings last week, particularly in the technology sector. So Apple, Amazon, Facebook, all outperforming expectations. Let's see if Uber can follow suit. Another component of that tech-driven UT100 index. Disney earnings will also attract a lot of market attention. Of course, the closure of theme parks and movie productions across the globe has really weighed heavily on market sentiment. However, the recent launch of Disney Plus has been a huge success, over 54 million subscribers in the first few months post-launch. So presuming users maintain their subscription beyond that 7-day free trial, it's likely that revenue is going to reflect that huge success for Disney's latest project. Also keep an eye on gold this week, an incredibly exciting market. The precious metal continues to print all-time highs, most recently a high of 1981. However, market bulls have been unable to breach that level and have now tried on 3 separate occasions. It's very evident on a 4-hour chart. The price has pierced through that level and been unable to sustain itself above that. And there's now a line in the sand there for market bears. And price action is now choppy. It's two directional as opposed to that recent one-way rally. We've seen aggressive sell-offs, recoveries, etc. So let's see what this week brings. Central bank rhetoric will play a huge role in the price of gold. And then the US elections, they're quickly approaching in early November. So keep an eye on those state-by-state polls. Donald Trump bidding for another 4-year tenure versus the veteran Joe Biden. So any shift in political fundamentals is really going to impact global FX and stock markets immensely. There's going to be plenty of content and webinars on those elections in the coming months, so please stay tuned for that. That concludes this week's webinar. Please reach out to me on Twitter with any further questions. I love to interact with you all on there. My Twitter handle is @EquityMark, equity with an I and Mark with a K. Thank you all for joining and good luck for the trading week ahead.